Okay, hi everyone. Welcome to Master Key Associate. Tonight we are going to continue with our topic in SFM, Advanced Investment Appraiser. Advanced Investment Appraiser. So, in the first class, we look at the introduction to this topic, and we examine one question, okay, one example, just to illustrate what investment appraiser is all about. We talk about the discounted cash flow techniques, which are the NPV, the IRR, the modified internal rate of return, discounted payback period, and lots more. We also talk about the non-discounted techniques, which are the accounting rate of return and the payback period. So what we did class in the first class was to lay the foundation for us. That was just too basic. That was too basic. However, it's also important to remind us of those things we need to know. So class, tonight we are going to step higher, okay, into the required level according to the ICANN syllabus. Now, the topic says capital budgeting decision or investment appraiser. Now, from that word capital budgeting decision, you could see that it talks about budgeting, okay, and decision making. In decision making, there are certain cash flows that we need to consider, okay, because all the cash flows might not be relevant to a particular decision. So we talk about relevant cash flows and non-relevant cash flows. So tonight, let us see the relevant cash flows for investment appraiser. Okay, the relevant cash flows for investment appraiser, because it is not all the cash flows that will be needed when you are taking a capital budgeting decision. So after this, I will show us the template, the format, the table for NPV, and I will also show us certain things, okay, that are some things that we need to also know before we take a question. So what are those cash flows? Number one, you have the initial, okay, outlay, that is the cost of investment. The cost of investment is an important cash flow to be considered. Next, you have the scrap value or residual value. Some may call it what? Salvage value. Salvage. Yes, the scrap value or the residual value is the cash proceed that you are going to realize from the disposal of the scrap asset. Is that clear? That is at the end of that particular asset, okay? When you sell the asset, the cash you are going to realize is called the scrap value. Therefore, it constitutes part of the cash inflows to the project. Next, you have working capital. Next, you have tax, receipt, and payment. Yes, when you are dealing with advanced investment appraiser, we are going to talk about tax implications, okay? So the tax here is of two types. we have the tax receipt and the tax payment. So tax receipt and tax payment is also an important cash flow. It is relevant. Next, the sales value. Okay, the sales value or revenue. The proceed, okay, from the product produced by the machine. Next, you have here the variable cost. The variable cost. So this variable cost includes, we talk about the direct material, the direct labor, okay, the variable production, overhead. 7, about specific or incremental fixed cost. Yes, there are two kinds of fixed cost. We have incremental fixed cost. Okay, this is the fixed cost that is incurred as a result of that decision or the project. So it means that if I am not taking that decision, okay, in the first place, I am not going to incur that fixed cost. It is called specific or incremental fixed cost. Next year, say opportunity cost. The last one, say avoidable cost. Yes, any cost that can be avoided, okay? Avoidable cost is the cost that can be avoided as a result of the decision taken. Is that clear? If I am going to embark on this project, I am going to incur this particular cost. However, if I am not doing that project, it means I am going to save that cost. So any avoidable cost, okay, is relevant. So that is that. Next now, we look at the non-relevant. Non-relevant cash flow. Okay, number one, non-cash item, e.g., depreciation, impairment, etc. Any non-cash item is not relevant. Okay. Next, general fixed overhead, okay, or apportioned fixed overhead. Yes, general fixed overhead means general fixed cost or apportion or absorb all these fixed costs, you are going to incur them, whether you operate or not. So they are not avoidable. Therefore, they become irrelevant. The next we look at is the cost of research. The cost of research and development. Research and development costs. Next, you have financing cash flow. Yes, financing cash flow. E.g., you have here interest on loan, loan repayment, dividend. All these financing cash flow, the interest on the loan you have taken for the project and the loan repayment are the cash flows that have been considered to determine the cost of capital for the project. So it will amount to double deduction. Okay, they are not relevant. 5, talk of committed cost. 6, talk of notional. Class, these are some of the non-relevant cash flows. Now, you will see some of these things in a standard question out there. That is why the principles of relevant costing becomes important here. Yeah. So the principles of relevant costing becomes important when we are taking a capital budgeting decision. There are certain cash flows we have to take into consideration. Why there are some cash flows we have to jettison, okay, we have to discard. So these are the key relevant cash flows and the non-relevant cash flow. I might ask you, as part of C or D, what are the relevant cash flows that might be considered in a capital budgeting decision? So that is that. Next, let's look at now the template, okay? The template. Don't forget, what we are doing here is advanced investment appraisal. So what is the template? The formula. Is that formula? Let's say the table, okay, the table for the NPV. Yeah, the table for the NPV. The table for the NPV, because NPV, like I said, is the mother of all investment appraisal technique. The NPV is the mother of all investment appraisal technique. So let's say NPV format. Now, class, for you to embark, okay, on investment appraisal, there are 3 things you need to know. Number 1, the number of years, okay, of the project. The number of years of the project. Number 2, the relevant cash flows. Exactly, which we just considered. Number 3, the relevant discount factor. Take note of that word. At this stage, get used to the word of relevant discount factor. And I'll be showing you very soon why we use the word relevant discount factor. Okay, let us assume that here we have 3 years. 3 years. Year 0, year 1, year 2, year 3. This is the number of years of the project. Now, the first thing is your sales. Is your sales. Your sales value, and this sales value would have to be calculated. Yes, the selling price times the unit stood. However, the selling price might be subjected to inflation. We are coming there. Now, next, let's relevant, okay, cost. Class, when you are doing MPV, okay, your first target, hello, your first target should be the cash profit. In finance, we use the word cash profit and not net. Now, what is cash profit? The cash profit is the sales value less the variable cost and the specific or incremental fees cost. Okay, so let's say here we have the direct material, direct wages, the variable production overhead, and the specific or incremental fees cost. So you have all this. You have all this. In some question, you might just have just 2 or 1, or you have it as what? Variable cost. So my sales less this, I have my cash profit. This is your first target. Hello, your first target. So I have my cash profit. So after then, okay, what do? I deduct my tax. The tax you pay, okay, on profit. So the tax you pay, hello, depends. It could be on actual year basis or preceding year basis. If it's actual year, the tax of year 1 will be paid in year 1. Okay. If it is preceding year, hear me, the tax of year 1 will be paid in year 2, of year 2 paid in year 3, of year 3 paid in year 4. So you need to understand the tax pattern, okay, payment in that question. And if it is silent, hello, it means it is on what? On the actual year basis. Let's assume here at 30%, okay, assumption on the actual year basis. After the tax on profit, there is another tax we call the tax savings on capital allowance. When you incur a qualifying capital expenditure, okay, we use the word capital allowance, not depreciation. So the tax savings on capital allowance represent cash inflow, okay, to you, because it is a kind of relief that is given to you for incurring for incurring, okay, an expenditure on a qualifying capital expenditure. Is that clear? So after this alone, the next is the tax savings on capital allowance, except the question specifically tells you not to do that. On capital allowance. Now, earlier class, I told us under the relevant cash flows, I talk about the tax receipt and the tax payment. The tax payment talks about the tax you pay on the profit, while the tax receipt is the tax savings on capital allowance. So it also follows the same tax rule. Is it on the actual year basis or the PYD? Let's assume it's on the actual year basis. You also add here. Now, the cost of investment now, initial outlay, the cost of investment, okay, in year zero, hello, sometimes, hear me, sometimes, okay, please, I'm coming. Sometimes, class, the cost of this investment might not be incurred in year zero. This is where you should listen to me. Sometimes the examiner might say part of the cost of investment is paid in year zero. Okay, the balance in year one. Generally, okay, we all believe that the investment is always made in year zero. I have seen 3 ICANN questions whereby the cost of the investment is not fully incurred in year zero. Part was incurred in year zero and the balance in year one. Please take note of that. Next now, the scrap value. If you recall, yesterday, okay, I said something. When I was giving us the cash flows to be considered under MPV, okay, IRR, and the payback period, I said the scrap value, which is the residual value, which is the salvage value, represent cash inflow. So the scrap value is an inflow. Remember, the scrap value will be an inflow in the last year of the project. So it comes here as an inflow. Next now, investment in working capital. Class, working capital is another key concept in advanced investment appraisal. Now, investment in working capital, this is the amount of cash that is also invested in addition to the original cost of the investment. Now, we need cash to run out or to sort some things, okay, in the course of the project. So any investment in working capital will be released in year zero. So in year zero, are we there? 2, any investment in working capital will be recovered in the last year of the project. Year as inflow. Exactly. So this are what you have. You now look at this. The net cash flow. This you have here, negative. What you have here too depends on the answer. Out there. So now the discount factor. the relevant discount factor. Okay, let's say you have this, you have this, you have this, you have this. Then multiply, you have your PV. Your PV, your present value. Therefore, your NPV could be what? Positive or negative. Okay, so what is the NPV? The sum of this PV inflow less this outflow out there. Please go ahead. Yes. Go on. Bello. Hello, are you still there? Bello, your hand is up. Okay. So class, that is what? The template for the NPV. So it is based on this now, okay, that we are going to find the internal rate of return if the question says so. It is also based on this, we are going to find the modified internal rate of return if it is in the question. Also based on this too, you are going to find the discounted payback period. You now see why NPV is the mother of all investment appraiser techniques. So you will just come here and pick the net cash flow for other techniques. So you must get this right. Once you get these ones right, so there is no issue. Now, Bello, please bring your hands down. Bello, please. Bello, please bring your hands down.
It's not Bello, sir. It's some Tochukwu.
Please help me tell him or her so that I can have a white screen. Thank you. But he or she adding that I was trying to call. Okay. Okay, class. That is that. So, now, I hope up to this moment, no issue, class. Hello. Let me entertain one or two things now. Yes, class. Up to this moment, any issue?
So I want to say something.
Okay, okay, go on.
So from my observation, it looks the same as skills. Is it
skills? Thank you. Yes. Thank you, my dear. You know what? Skills. Yeah. That is true. Just that. Okay. The items you might have in SFM out there is more. Okay. Is more than what you have in skill. Don't let me use the word might. The one you have, okay, what you have here, okay, for SFM, okay, is what is more than skills. But for those who have passed through my skills level, FM, definitely you are having no issue. Okay, we are just going to build on this same time place. Yeah, you are correct. Is that our place? Next person.
Hello, sir.
Okay, go on, sir.
Hello, yes, sir.
Go on, sir.
My question is this: from the format you gave to us, the working capital is it for the initial and the end of the year? Because for year one, year two.
Sir, okay, sir. I am still going to dwell more, okay, on that because shortly I'll be taking you through the breakdown, okay, of some of the items here. Is that clear? So now this is the idea, sir. Working capital, okay, from that word, you know that a project could take like 5 years, and 6 years. After the investment on that project, it is expedient that we have cash on hand. Is that clear? So working capital is an additional cash investment, okay, that is used to run the project for 1 or 2 contingencies on it. Is that clear? And the rule is that the working capital is released in year 0 with the cost of investment. That is why it is what also in year 0. And also at the end of the project, by the time we realize the project, we are going to recover all the investment in working capital. That is why in the last year, okay, you can see that in the last year, it is what? It is an inflow. Abi? An inflow. In year 0, outflow. In the last year, an inflow. So every investment in working capital will be realized in the last year of the project. It makes sense because by the end of the project, I should have realized, okay, my inflow, my income. So I would have gotten back what I invested. However, the working capital might be changing every year. It could be increasing or decreasing. We call it movement in working capital. I will show you that soon. Are you clear, sir? Next, please.
Yes, sir.
Okay. See, that is
Mr.
all. So
Kamal,
let's go now. Okay, yes,
Mr.
go on,
Kamal, please,
go on.
one question,
Yeah.
please. Good evening, sir.
Okay, go on.
Please, can
Yeah,
you
good.
explain why you have 0, year 0, year 1, year 2, year 3? Why are you starting with 0, please? Thank you.
Okay, thank you. Now, basically, okay, anytime you are investing, right, the very year you put your money, you drop that your money on that investment in finance is called year 0. Are you there? Because that year you are not gaining anything. Are you? No. You are only what? You are only investing. Exactly. So
Hello, sir. I
every
can't hear you,
project
please.
year 0 is the year you are investing. Okay, is the year you make the investment. Is that clear? Is the year you make the investment. So every project begins with year 0 because that is the year you make the investment. Is that clear? Are you clear now? So now year 1, year 2, year 3, as used here, we assume that the project has 3 years. In your own question, it could be 4 years, it could be 5 years, it could be 2 years. But for any project, you start with what? Year 0. Is that clear? So that is that. Next now, let's talk about the special item. Yeah, the special item, okay, in investment appraisal. Number 1, tax. Yes, taxation. Please, class, be with me here. Now, taxation is one of the major special items in investment appraisal. Exactly. And the tax you will have here, okay, is of 2 types. 2 types. Here you have the tax paid on profit. Okay, this is an outflow Two, the tax savings on capital allowance. This is an inflow. Is that clear? So you have two types of taxes in appraisal: the tax payment and the tax receipt. The tax payment is a tax you pay on the cash profit. Out there. While the tax savings on the capital allowance is a tax relief. So it's an inflow. Is that it? One is outflow, one is inflow. However, you need to understand the basis of the tax. Is it on the actual year basis, or is it on the actual year basis? Your AYB, or preceding year basis? The PYB. Now, if it's on actual year basis, okay, it means that what? The tax payment for year one will be paid in year one. So just like that. So that is that. Next now, how do you now compute the tax savings? Yes, go on.
One is this actual year basis, is it only for capital allowance?
No. You get it. See your tax, okay, in the question could be on actual year basis. Now, if it's on AYB, okay, the tax payment will be paid in that year, okay. But if it's on PYB, the tax of year one will be paid in year two, or even year two. Is that clear?
So I'm still confused because we have two tax here: tax paid on profit and tax on capital allowance. So I'm asking that, okay, the one for the capital allowance, the one that we're using, which one are we using? Actual year basis.
You are using the same basis for both the tax on profit and the tax savings on capital allowance. You are using one basis for both of them in a question, okay? You can't use the two for two. You are using one. It could be actual year basis or preceding year basis. So let me show you now how to do the tax savings. Okay? Computation of tax savings on capital allowance. Now, though going by the NTA now, okay, we have just one allowance. It's called annual allowance. No more initial and no more balancing adjustment. The balancing charge and the balancing allowance. However, I am still going to show you based on the old one, okay, we still use. Exactly. So now, let's say there you have here the cost here, the capital allowance here, the tax savings. Let's say at 30%. Now, plus tax savings alone on capital allowance, it is simply the tax rate multiplied by the capital allowance. That's all. The tax savings on the capital allowance is the tax rate multiplied by the capital allowance. So it means that you need to first of all determine your capital allowance. Now, the capital allowance now under appraisal can be determined in two ways. One, reducing balance basis. Is that clear? Two, straight line basis. So I will show you now the reducing balance format. Okay, let's say here you have year one, Abby.
Year zero.
Year one, no, year one. Cost. The cost of what? Of the asset. Now, this is your capital allowance. Okay, capital allowance, right? This you have this. The task. Who is that now? The task.
Salah, mute your mic now.
Okay. Oh, I'm so sorry, I didn't know.
Okay. So the cost of the what are the investment less your capital allowance, okay? This is what on the reducing balance basis. Is that clear? So the rate times the cost you have the sold. This will come here, your capital allowance for the first year. Is that clear? So second year, your capital allowance, okay, is the rate times the TWD. You have your capital allowance to second year. This also come here. You have your tax rating. You have your tax rating down value. See, the third year too, your capital allowance, the rate times this, you have this. So you have your tax value. Now, let's now assume that this project has 4 years, okay? So in the last year, what you are going to do is what you are going to compare, okay? Let's say the scrap value, let's say for the year 4, see, the scrap value with the what? With the tax down value. So what you may have here, okay, could be either balancing allowance or balancing charge. Let's say it's what? Balancing allowance. Out there. Balancing allowance. Balancing allowance. Now, you have a balancing allowance when the carrying value is more than the what? The sales, okay, proceed out there. And that is a loss to you. In that case, then the tax man would give you compensation. So here I have here, this allowance will come here as your capital allowance. Is that clear? Now, your tax savings is the tax rate multiplied by the what? Capital allowance. 30% of this, you will add this, you will add this, you will add this, you will have this. So these are your tax savings that you will not take to the what? The table for the NPV. Exactly. Now, adding being, okay, it is on a straight line basis out there. On a straight line basis, our capital allowance would have been the cost less residual value over the number of years, okay? Here you have the capital allowance. You know, on that straight line, you'll be having the same amount as your what? Capital allowance. Therefore, my tax savings now, okay, is the tax rate times my capital allowance. So in that case, you'll be charging the same amount as capital allowance, and you'll be having the same value as tax savings on capital allowance. That is that. Next now, I go to the next one. It's inflation. Please be with me here, please. Inflation. The next item, the first one is taxation. Now, ICANN is not going to ask you to define inflation. Of course, we all know that what inflation is a general increase, okay, in the price levels of goods and services. And the effect of inflation is that it reduces the value of money. Now, how does inflation come to play in investment appraisal? Yes. Now, so not this appraisal, okay, is for number of years, either 5 years, 4 years, or 6 years. So it is possible that there will be a change in the price levels of goods and services. So we have to factor in an inflation. So under appraisal, okay, or investment, inflation affects 3 things. Okay, it affects what? Number 1, the revenue. Yes, that is the selling price. Yeah, the selling price of the goods. So, number 2, the cost. 3, the discount factor. These are the 3 things that inflation affects in investment appraisal. The revenue, why? The selling price might be inflated, they will tell you. The cost too, and the discount factor. The discount factor, you know, is the cost of capital. Okay, types of inflation. We have types here in appraisal. One, we have specific inflation. 2, we have general inflation. Please be with me here, please. Now, the inflation in appraisal is of 2 types. Okay, specific inflation, okay, is the inflation, that affects certain cost and revenue items. Exactly. That is, this kind of inflation is specific to certain cost and revenue items. It could what? It could affect your sales. Okay, let's say sales. Okay, material cost, labor cost. Okay, even what? Even specific fixed cost. So they are going to give you the specific inflation rate for each of them. Now, general, okay, so this kind of inflation affects the general price level. See now, the general price level in the economy. Is that clear? Now, it is this kind of inflation that is used to adjust the discount factor. This inflation factor is used to adjust the discount factor. Yes, it is the general inflation rate that we use to adjust our discount factor. So it means that in the question, they will give you two inflation rates, specific and general. Sometimes you might not have the general. If you don't have it, it means there is no adjustment to the discount factor. Is that clear? But you might have the one that pertains to certain cost item. Is that clear? So that is that. Next now, let's talk about. Go on, please. Go on, please. Please go on. Hello, go on. Please, man, go on, man. Cash flows. Now, class, you might have two kinds of cash flows in investment appraisal. Okay, two kinds of cash flows. Hear me. This is where you need to pay attention. Now, we have what we call A, money or nominal cash flow. B, you have real cash flow. Class, when you say money cash flow, hello, money cash flow is also nominal cash flow. Icon is funny. Distinguish between money cash flow and real cash flow. Now, money cash flows are the cash flows after inflation has been considered. Is that clear? They are the cash flows you get after adjusting for inflation. Okay. Let's say inflation adjusted cash flows. So money cash flows, okay, are the cash flows you have after you have considered the inflation. Why real cash flows, okay, is a cash flow before inflation. Is that clear? So anytime you have an inflation in the question, please take note of what I'm saying now. Anytime you have an inflation in the question, it means that you have automatically converted the cash flows to money or nominal cash flow. Does that make sense? Yes. When you have any inflation in the question, even it's just one, even let's say it is just one rate, let's say to material, just to one item, the moment you adjust any of the cash flow by the inflation rate, you have automatically converted that cash flows of the project to money or nominal cash flows. But the cash flows before you consider inflation is what we call the real cash flow or the current price cash flow. Is that clear? Now, when you now convert the cash flows, what should now be the discount factor? Earlier, I talked about relevant discount factor. Abi? Okay, let's say for money or nominal discount factor versus real discount factor. Yeah. Earlier, I talked about relevant discount factor. This is where I'm coming to. Hello. The money or nominal discount factor is the discount factor after inflation has been considered. After adjustment for inflation, okay? After inflation has been considered, why the real discount factor is the discount factor before what? Before considering inflation. Now, this is where we are going to. Which of these discount factors should be used to discount your net cash flow? So, we now come here. The relevant discount factor, please just watch me. Number one, if my cash flows are in money or nominal cash flows, it means what? I must use money. I must use money or nominal discount what factor. Yes. If the cash flows is in nominal, I must use money or nominal discount factor. So that is where that word comes in, relevant. Two, if the cash flows are real cash flows, I must use real discount factor. Now, this is now the question. If, hear me, if the cash flows are money cash flows, hear me. If the cash flows are money cash flows, after we have considered inflation, and in the question, hello, the examiner tells you that the cost of capital is a real cost of capital. It means what? I have to convert from real to money or nominal discount factor. Is that clear? Okay. Please, just watch me here. Conversion of discount factor, okay, either to nominal, okay, or real. Now, here you are going to what? Use Fisher's equation, okay? This is done by using Fisher's equation. Yeah. Then here we have the 1 plus m equals to 1 plus r, 1 plus I. Okay. M is the money. Please, I'm coming. M is what? Is the money. Is the money. N is the money cost of capital. That is the money discount factor. Y R is the real cost of capital. the discount factor, why this I is the general inflation. No, I told you earlier, inflation rate. This one is just constant. Okay, go on, please. Go on. Fast.
So there are some people that say they want to be let in.
Okay, sir. But I can't see anybody here except one person. Okay. Thank you. Class. SFM. This is where the issue comes from. Remember, your relevant discount factor, my God, is a function of the kind of cash flows you have in the project. Hear me? The moment you apply inflation factor to any of the items, you have automatically convert the cash flows to nominal or money cash flow. It then makes sense that our discount factor should be money or nominal discount factor. So this is what you are going to use, the Fisher's equation, to convert your discount factor either to nominal or to real. Please, on that, any question, please? Yes?
Yes, sir, please. I have a question.
Okay, go on.
Yes, can you repeat the explanation you gave on why it makes sense to convert to money or nominal?
Yes, it is simple. Okay, if your cash flow is in money terms, then you should use money discount factor. Now, this is the question. You need to understand what we call money cash flow. Money cash flows is the cash flow after inflation has been considered. So it makes sense that our discount factor too should be a money or nominal discount factor. Okay. I hope you are clear with that. So the last one, our class. Okay, go on. Let's go on.
Yes, sir. Please raise the board up, sir. Please. No, up. You are no. All right. Thank you, sir.
So, class, the last one here is what is investment in working capital. Okay. So after this, we are going to take a question. Okay. Yes, go on. Shall you go on?
Yes, sir. Please, I want to ask that is it possible that different line items or different items in the question can have different situations? Is it possible?
See, honestly, I can barely hear you. Okay. It's like you are having a bad network.
Okay, sir. So what I'm saying is it possible that different items in the question, maybe revenue, cost, different items, they have different inflation rate that applies to them? Is it possible?
Yes, 100%. Okay, 100/100 possible. Okay. So we call that specific inflation. Okay. For instance, when they give you the rate of inflation for the selling price, 2%, material 5%, fixed cost 6%, labor 8%. So that is called specific inflation. Exactly. It is 100/100 possible. Clear? Are you clear? So you just have to locate, okay? You just have to determine what is the inflation that affects this particular item. And sometimes they may give to just 2 items, and that's all. So it is your own duty to know which of these items is affected by inflation. Now, the last one here is the investment in working capital. Investment. after tonight, I don't expect any of you to see ICANN question on appraisal and one of you. Okay. So, investment. Yeah. Earlier, somebody was asking me, okay, Abre, there is no how you are going to run a project. Even in a normal business, you have working capital. Is that clear? So an investment in working capital is an additional cash investment that is made on that project. Okay. So this is the rule. This working capital is also invested in year zero, in line or along with the cost of the investment in year zero. Exactly. So at the end of the years of the project, you are going to realize the investment you have made in working capital in year zero. It will now serve as an inflow in the last year. However, there could be movement, okay, in the working capital due to inflation rate. It could be increasing every year. So let's see, please. Treatment. Sorry, I'm coming. Treatment of working capital. Please, I want you all to hear. Treatment of working capital. Treatment. Now, number one, working capital okay, is released in year what? Zero. Okay, that is what? As outflow. As outflow, okay, as outflow. Yeah, exactly. Is what? Is always written what in zero as outflow. Yeah. Next. Working capital investment is fully okay, is fully recovered in the last year of the project. Meaning what? As simple. Next now. Increase in working capital, okay, over the years of the project is treated as outflow, okay, as outflow in each year. The last one, decrease in working capital over the years of the project. As inflow. Okay, that is that. So class, that is what you should take note of. So right away, let's go now to the question, please. Let's to the question. Let Azima,
Sir, sir.
please help us go through, help us read out number 2.
Okay, Washington PLC.
Yeah, please, hello, class, follow her as she reads it, please. Follow her, please. We are together. Please go on. Thank you. Go on.
Washington PLC is considering a project whether or not to commercialize an innovative muzzle toning device, that's MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years, after which technical advances will bring more sophisticated devices to the market, and the sale of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year. Initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. We have information on for year 1 to year 4. We have demand per unit, and then we have the selling price, which is in current the selling price in current price. We have variable costs in current price per unit, and then we have fixed costs in current price per unit. Now we have more information. Selling price information rate and fixed cost inflation are expected to be 5% per year, and the variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed costs, incremental fixed production overhead, which are wholly attributable to the project. The production equipment for the new device will cost 120 million, and an additional initial investment of 20 million will be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million when the production and sales cease. The average general level of inflation is expected to be 30% per year, and working capital would experience inflation of this level. Capital allowance, that is tax allowable depreciation on a reducing balance basis, would be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. Washington PLC has a real cost of capital of 7.8%. You are required to calculate MPV, IRR, and discounted payback period, and MIRR. B, on the basis of the MPV, advise if the project should be considered. C, what are your assumptions on the project? Should it be considered above?
Thank you. Now, That is a what full question that incorporates inflation, working capital, everything you need to know under appraisal. Please, let us do it together, please. Because after this one, okay, by Monday, we are going to look at the question on appraisal that also involve the adjusted cost of capital, okay, your beta and all that. So we are what trying to build the knowledge one after the other. Now, I said, the first thing you ask yourself under appraisal, one, what is the number of years? Okay. Two, the what relevant cash flows. Three, the relevant discount factor. Now, how many years do we have in this project?
4 years.
Thank you. Year zero, see? Year zero, year one, year two, year three, year four. Thank you. Aha. Based on what we have there, that's 4 years. So next now, let's keep it in thousands. In thousands. You know, I said that what you should watch out for is your cash profit. And what is cash profit? The sales revenue less the relevant operating cost, the variable cost, material cost, labor cost, and the incremental fixed cost if you have. Sometimes alone in the question, they will give you cost savings. You hear me? Cost savings. That cost savings is the same as your cash profit. Write down this. Cost savings is what is the same as your cash profit. When they give you the cost savings, they won't give you information again. Yes, about the sales and the variable cost. So you just start from that, okay, and you walk down. But here we have the sales. The sales. So in the question here, it is clear that our selling price is what is affected by inflation. Okay? Let's see. At what rate?
5%. 5%.
At 5. Thank you. This is called specific inflation at 5%. So let's come here now and do the first working here. Working is 1. Sales revenue, you know, is what? Is the price times the quantity. Yeah. Yeah, I have year 1, year 2, year 3, year 4. Okay? Year 4, and the selling price is what is 2. I mean, is what is 2,000. Okay, is 2,000 for year 1. 2 is what 2,002, right? 3 is what 1,006. 4 is what 1,005. Sometimes they might give you just one selling price for 5 years. So the same thing, okay? Just apply your inflation factor. So here you say inflation. Hello, inflation at 5%. You have 1 plus R, okay? Let's say 1 plus I, okay? overhead. This is what your inflation factor. Exactly. So for year 1, you put 1, 2, you put 2, 3, you put 3. Here we have here 1.05 year 1, 1.05 year 2, 1.05 year 3, 1.05 year 4. You can see. Yeah, I have the adjusted selling price. This price, okay, this.
Two
Yeah, I have
one.
here
2-1.
2, 1. Yeah, I have 2, 4, 2, 6. Yeah, I have 1, 8, 5, 2. Yeah, I have 1, 8, 2, 3. Hello. Sometimes they might give you just one selling price. Okay? And then it will be what? It will be adjusted by the what? By the factor for the inflation for over the years. But here you are having different, the same procedure. Now, remember, our sales revenue is the selling price times Q. Now we have the adjusted selling price now. Okay? So here, what is it? Here, what do we have there as the output? Let's check. The demand. Okay, the demand. The demand. Okay. Okay, the demand. Okay. So, should we put here, let's say, the demand. Okay. 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 For year 1 is 20,000. Year 2, 70,000. Year 3, 125,000. Year 4, 20,000. Here we have the sales now, okay? Revenue. Let's keep 3 what? 0 here, right? So this times this, here we have 42 million. Okay? Here we have 169,800. 169,800. Sorry, 820. 169. Here we have 231,500. Here we have 36. So you keep what 30 here, so that you don't have 2 large figures. Okay. So that is what our sales figure. So you now come here to the project. Okay. Say working is 1. Have here 42. Yeah, 169,820. 231,500. 36460. So class, that is your sales now. Next now, working is 2. In this case here, what do we have there as our variable cost? Do we have it in breakdown form, or we just have it as one?
As one.
Yes. As one. Okay. As one. Okay. Thank you. So the variable cost here See, when I say in breakdown form, okay, it means you have for material, for wages, overhead, okay. Sometimes they could just give you as variable cost. That is as one. That way, the variable cost, okay, per unit times what? The demand, okay, times the quantity too. Quantity. Yeah. Year one, year two, year three, year four. Class, is that variable cost too affected by inflation? Yes.
Yes.
At what rate?
Yes.
4%.
Thank you. Because now, year five, year four, this is called specific inflation factor. Okay. The variable cost, okay, in see, the variable cost here per unit. Okay, before inflation, you have 900 naira. Here you have 1,000. Here you have 1,020. Yeah, so 1,020. So inflation factor two at 4%, 1.04. Year one, 1.04. Year two, 1.04. Year three, 1.04. You cross this. Here I have my adjusted variable cost per unit. Here I have my adjusted variable cost per unit. So 936. Here I have 1147. Have 1193. Then the demand too. You have 20,000, 70,000, 125,000, 20,000. There you have the total variable cost now. The total variable cost you keep this area. Here you have 18,720, 75, 740, 143, 375. You have 23,860. Okay, so we less now the variable cost. So let's go up. We less that. 23,860. Now, which other relevant operating costs do we have there?
Fixed costs.
Fixed cost.
Thank you. Why? Tell me why? Why?
It is
Yes,
part
yes.
of
Why?
Part of the production.
Azima, you have not given answer. I said why?
that is part of our production.
So now you are saying anytime I see this cost in appraisal, okay, I should just pick it.
Sir, because it is attributable to the project.
That is the key word. That is the key word. It is specific. Okay. Incremental or specific.
Yes, sir, 5%.
5%. Okay, thank you. Okay. So, year 1, year 2, year 3, year 4. So the fixed cost, see, is 10 million. 10 million. Okay, let's keep it there here. Keep it there here. You have 10,000. So inflation factor at 5%. 1.05. Yeah, 1.05. 1.05. There you are. Adjusted fixed cost. Now the 10, 10. Please, I'm coming. 1025. 11,576. 12155. So that is the fixed cost. Okay. Yes, go on. Go on. Go on. I'm with you.
Okay, please, sir.
Please, go on.
This fixed cost in current price terms is in the question is 10, but you put 10,000 there.
Check. It's having 3 zeros. There. Check it. See now, is it what? Is it what? It's 10 million. Class. If I say, let us go together. Okay. Is what is 10 million. Okay. It's 10 million. There you are. 10. 11. 1, 2. So that's all now. Please, I'm coming. Here we now find the cash profit. Yeah, I have here. I have here. Cash profit. Okay. 12, 870, 83, 0, 55, 76, 5, 49, 3, 4, 4, 5. Okay, Candy, go on, please. Candy, go on.
Okay, sir, thank you. Sir, please, can you show us another method of doing this inflation? There's one method, it must not be raised to power 1. If you don't want to raise it to power 1, there's another method they can use to do this inflation.
Okay. See, what I have showed you, okay, is the best way. Generally, okay, this is what the inflation factor, okay, out there. Now, like now, if you are having the same figure now, okay, like this fixed cost is the same, the same for the 5 years. So let's say, year 1, I have my fixed cost to be what? To be 10 million and 1.05. Okay. That'll give me what? 10 Now for year 2, just say 1.052, okay, times what you have here. Here you have 11.025. Year 3 also, just say 1.05 times 11, okay. So like that. So this is the other way you can do it. But what I have given you is the easiest method without any confusion. Are you clear now? So, but you use this one, okay? This one when you have the same value being inflated. Okay, go on. Bright, go on. Bright, go on. Your hand is up. Okay, class. After this now, after the cash profit, what is the next thing? Yes.
Tax.
Yes.
We
Thank you.
Tax.
30% on profit.
Thank you. Tax. Now, I told you, what is your tax this year? Your tax this basis? Is it PYB or AYB? Check for me. Tell me.
PYB
Yes?
in area.
Is in area.
Okay, thank you. So you see, the tax of year 1, you pay in year 2, So here you have here 30%, okay, of 1218 to be paid year 2. There you have 3834. 30 of this, year 3. There you have 2417. Of these two, 2296. So this you come here. Here you now create what? 1 column extra, 5 years. Okay, just for the tax effect alone. Okay, here you have 134. Exactly. Yeah. So after the tax now, what next? Tax savings on what? on capital allowance. Okay? The tax savings So the first thing we are going to do now is to first determine our capital allowance. Now, what is the basis in this question? Yes?
We are going to calculate our capital allowance based on statement.
Reducing balance method.
No. Thank you. Reducing balance method. Are we there?
Thank you.
So, see, you need to take note of this. So, it could be on straight line or the reducing balance. So, let's come here now and do our capital allowance. W working 5.
Working 4.
4, thank you. 4. Tax savings on capital allowance. See, on capital allowance, that be the tax rate and the capital allowance. So, here, yes, the cost, the capital allowance itself, the tax savings. Are the company tax rate, the income tax rate. Okay. So, have year 1. Okay. So, what is the cost of the asset? Go on.
Sorry to bother you. The tax on profits for the first and second year. No, I'm getting a different figure.
Really?
30% on private.
Yes.
Give me 3861.
Are you sure? Check.
3834 for second year 24917.
You get 3834.
30% of 12,718.
780 or 870?
870.
870.
Is it 780 or 870?
870.
3861 now.
Please wait.
Okay, 3861.
30% times 12, 870. Okay, 3861. Thank you. Okay, let's check others. 20 times 83055.
So the problem is from their subtraction. No, it's 12,718, not 12,817.
12 what? 780.
718.
Okay. Yeah,
Yes, sir.
12,780. Okay. Thank you.
So the tax will be 34.
Is what?
3,834. 3834. Then year 3. That year 3 will be 24,917. Year 3, 24,917. The tax 30%.
24917. Okay, 2.
Yes, sir.
Wow. How come now? 24917. Then year 4.
Others are correct.
Other ones are correct, sir.
Thank you. Okay, thank you. So it's good you don't write. You check with me. Yes. Okay. Now, class. So year one, okay, the cost. You see, if that project journey is having 4 years, 4 years, you will do the capital allowance for 3 years. Exactly. Okay. Over there. And in the last year, you are going to do the balancing adjustment to compare if there is a balancing charge or allowance. So here you have 120 million. And the capital allowance is at 25%, Abi. Right? At 25% of 120. That'll be what? 3 million. So
30 million.
Year, you have
it's 30 million.
30 million, sir.
Okay. Thank you. Here you have the tax rating
Down value.
That'll be
90,000.
Now, this is a capital allowance for the first year. Second year, year 2, your CA will be 25 of 90.
It will give us 22,500.
2,500.
65,700.
67,500.
You know what, Class, thank you. You know what, see, just watch me, okay? Do it, okay? Please, anywhere I use one figure, it's okay. Just tell me.
Okay, sir.
Thank you.
All right,
so
sir.
that the video will not be have the task. Just watch me, okay? Where I used to just tell me. Now, year 3 now. The CA will be 20. Hello, your mic. 967. That'll be once. Hello, your mic, please. Your mic. 168. Please mute your mic. Right, please, your mic. So 16887 here. 16875. The task within down value for the third year, that'll be 50,625. Now, class, you know, in the fourth year now, okay, you are what? Okay. Class, do we have the 25% in the question?
100 divided by 4. Give us 25%.
Thank you. Get it? Thank you. By 4 years. Thank you. Correct. Now, in the last year, okay, the fourth year, you are going to compare the sales proceed, okay, with the what? With the tax down value. So the sales proceed. So this is what the amount we are going to realize when we sell the scrap. So it's what is 10 million. See, this is the value of the asset. See how much we are getting. Gain or loss? Loss, Abi. 4625. This is called balancing allowance. Okay. Hello. Balancing allowance. Out there. Now, the balancing allowance, okay, is a loss. It will give rise to additional capital allowance, okay? 4625. So these are the capital allowance. So our tax savings now is 30% of each, okay, of each. There you have 9,000, 6,750. You have 5,630. You have 1,2,188. These are the tax savings, okay? The tax savings we are going to claim. So remember, they are inflow, okay? They are inflow. So we come here. They are inflow. And then also it will also follow your tax pattern, okay? Aha. Your tax pattern. So there you have. This is what is on the PYB. That tax savings of year 1 will be claimed in year 2, 9,000. Year 2, in year 3, 6,750. 3 in what? In year 4, 5,063. 4 in what? Year 5, 1,2,188. Is that clear? So next now is the cost of the investment. Okay. The initial outlay there. Initial outlay is 120 million in year 0. See, I told you earlier that what? That part of this cost will be paid in year 0 and the part at the end of year 1. Okay. But in this case, it is what? Silent. So it means what? Everything is paid in year 0. That is how you flow. Please, with the question. Now, yeah, the scrap value is what?
10 million.
10 million.
Yeah, 10 million.
Remember, it's in year 4. In year 4. Now, I would have stopped here, but is there investment in working capital? Let's check.
Yes. 20 million.
Okay. Let's do that now. That will be working 5. And is this also affected by inflation?
Yeah, 3%.
3%.
Thank you. Okay. Working 5. Working capital at 3%.
Please mute. Oh.
Please mute your mic, please. Now, year 0, 1, 2, 3, 4. Class, I told you earlier that what? That your working capital follows what? Your investment year. So from year 0. So the original working capital let's put in thousands, okay? In thousands. In thousands, okay? Is what?
20 million.
How much? Okay.
20
million. 20 million. 20 million. 20 million. Do you know why it's not here? Because it is in year 4 you are going to recover all. Are we there? Okay. So year 4 is year of recovery. So inflation at what now? 3%. 1, year 1. You are here. I just said working. Now, anything raised to what power of 0 in mass is what? 1. So 1 is I have 20. Okay? 20, right? 20. Then times this here I have 20, 600. Here I have 21, 218. Here I have 21, 855. Okay? Over there. So now, you say changes, okay? Say changes or movement. Changes in working capital. Now, class, working capital, okay, in here is 0. Is what? Is an outflow, an outflow. Right. Okay. Remember, if there is a movement, and this movement is caused mostly when there is an inflation, okay? In some questions, the working capital will just be there, no inflation. It means I will just put this in the 0 and then come here last year and put it as inflow. But we add this as a second scenario. So the movement in working capital over the years of the project could either lead to an increase or decrease. And you know, as we have been taught in F7, in FR, that an increase in working capital is an outflow. So this minus this, is an increase, 600. This less this, is what? 618. Out there. So this less this is what? 637. Now, class, how much am I going to recoup now as my total investment in working capital? Tell me. Yes, class. Tell me.
20,000 year 1, year 0, there's 6,000 year 1.
Thank you. The sum of all this. Yes, because in year 0, I have put this. In year 1, I put extra. In year 2, extra. Year 3. So the sum of all this, that will be 21855. Okay. This is my working capital recovery. Are there? So let's go now. So here I have here working capital. Year 0, 20 million. Year 1, an increase. Year 2, an increase. Year 3, an increase. Now year 4, I will recover what? 21855 out there. So there is no any other cash flow again. Okay. Yes. If you check, class, at the beginning of this question, there are 2 cash flows there. what are they called? Tell me. Are we saying those cash flow? Yes.
Is it the initial cash flow and the additional one?
No. At the beginning of this question, check. Please, class,
okay.
Let's go there. That's 8 million and 2.5 million. What are they?
They are sunk costs.
Thank you. Why? Why?
They were incurred before the business started.
They are not relevant.
Yes, the cost of research and development. How are they are sunk costs. Okay, so we have now used all the cash flows now. Let's go now and find the net cash flow. The net cash flow. They have 140. So, Azima, please give us this figure.
For year 1, 12,180.
12,180. Okay.
Year 2, 87,603.
8 what?
87,603.
Okay. Year 3.
Okay, sir. 57,745.
57,745. Year 4.
14,398.
Thank you. 14,398. Year 5.
Year 5. 12,054.
Thank you. 12,053. I mean 4. Okay. Thank you. Now, discount factor.
11%.
Classes. 11. How?
It's 11%.
Are you sure? How? Why? Yes. Why?
We are going to convert it from real discount cash flow to nominal discount cash flow. So that's what we are going to use Fisher's equation. That is 1 plus M equals 1 plus R into bracket 1 plus I. Then you close the bracket.
Now, thank you. Have you done it before?
Yes, sir.
Okay, where?
I'll be coming down.
I studied many past questions, so I discovered the Fisher's equation.
Okay, thank you. Now, see, why do you think? Hello, see you. You are right, you are right. Now, why do you think we are going to convert? Just in a single sentence, so that everybody on this call will understand why we are converting. Yes?
Because from the question, the real cost of capital is 7.8%. So of which it was in the real discount cash flow. So and all the questions is based on money discount cash flow. So it means we need to convert it to money discount flow.
Calm down. Okay, thank you. You see, when we talk of relevant discount factor, that is what is being played here. All these cash flows, they are in money or nominal cash flows. Cash flows after inflation has been considered. And the question says that the cost of capital there is real. Also, in that same question, Here we have the general inflation rate, Abi. So we need to convert from what real to nominal, okay, by what using Fisher's equation. So let's say working 6, Abi, if I'm right, working 6 conversion of discount factor to nominal. Then the Fisher's equation is my 1 plus my money discount factor, 1 plus my real, 1 plus my I. Now, I have here 1 plus money. Okay. What I have there, Abi, is what real, Abi. What is that real?
7.8%.
What?
7.8%.
Now, say the real, okay, the real is 7.8. So if you convert this now to decimal, that what?
1 point.
No. 7.8. Divide 7.8 by 100.
0.078.
Better. So plus now is 0.078. 1. What do you have there as the general rate of inflation? Yes?
3%.
3%. That be what? Is 0.03. You can see 0.03. Just watch me. 1 plus M money. Here I have 1.078, 1.03. Now this times what are we times this, Abi? I have 1 plus money. That'll be 1 plus 11034. Linear equation. Open bracket. 1 plus M equals to 1 plus 1134. Take like terms. Let my M come here. 1 plus 0.11034 minus this one. Abi, my M becomes 0.what? 11 Abi 34. Then times 100. Times 100. Are you clear? That'll be 11%. Class. This is what differentiates SFM from FM. Yeah. You can see now. So understanding the rationale behind every action you take in SFM is very, very important. To not just know why you are making use of a particular thing. So we are saying now at 11%. Okay, so the discount factor now in the usual way, okay, for year 0 is always what? 1. Year 1 is 0.901. Year 2 is 0.812. Year 3 is 0.731. Year 4 is 0.659. You are going to do to year 5. Please, your mind, because I have cash flows there too. So Yeah, my present value this times this, okay, the same thing we did. This and this, yeah, 10, 9, 7, 4, yeah, 7, 1, 1. Please help me mute your mic, please. Someone's mic is there. Yeah, 4, 2, Adi. No, 4, 2. Azima, please help me confirm this year 3 PV.
Okay, sir.
Year 4, 9, 4, 8, 8. Year 5, 7, 1, 4, 8.
Everything is correct.
Everything is correct, sir.
Okay, thank you. Now, question A says, Abi, using what? NPV. Okay, NPV. Now, therefore, the NPV here is what? The sum of the PV of the cash inflow. You know, NPV is the difference between the present value of all the cash inflows. This, less the PV of the cash out, okay, flows. So if you sum all this together minus the outflow, that will give you what? Tell me.
956,000. 956 million.
Thank you. 9, 5, Ari.
Yes. Exactly.
Let's keep this zero, Ari. If you like, in full. All right. So we have just answered what? One part of the question. Still under question A. You see, the good thing you are going to do, okay, please, for ourselves, is to study this video, please, because by Monday, we are taking another ICANN question that involves the adjusted cost of capital with NPV. That will be the case where the main company diversify. So we do SFM in stages. So you must build one foundation to build on it. So the big part says that was now. If you find the what? The IRR, the IRR, the internal rate of return. The internal rate of return. Class. So do your internal rate of return. Hello. You need to discount factors, okay? One will give you positive NPV, other will give you NPV. As an SFM student, tell me, do I still need to calculate for the positive one?
No, sir. We already have.
Why? Why?
Because
we already gave us a positive figure.
Thank you. Thank you. So if 11%, okay, could give us this. So let's not try. I have what Abi factor. Say try.
Sir, please adjust your camera.
Please, please, I'm coming. Try. %, okay? Out there. What you try that. Now, class, when you are doing IRR, what are the cash flows? Is your net cash flows, okay? The net, not the PVO. You know, the net cash flows is like the cash profit. So it's the net cash, okay, flows. So here you have year 0, year 1, year 2, year 3, see, year 3, Year 4, year 5. Over there, let's keep and if you like, do your own like this. So same thing. I'm trying to save my space here. Okay, now my net cash flow in what year 0 is 140 million outflow. Year 1, 1, 2, 1, 8, 0. Year 2, 8, 7, 6, 6, 0. Year 3, 5, 7, 7, 4, 5. Year 4, 1, 4, 3, 9, 8. Year 5 now is 12, Abby, 0, 5, 4. You can see. Now, the discount factor, okay, at what? 15%. Okay, at the discount factor at 15%. Yeah, there is always one. One is 0, 8, 7, 0. 2 is 0, 7, 5, 6. 3 is 0, 6, 5, 8. 4 will be 0, 5, 7, 2. 5 will be 0, 4, 9, 7. 0, 4, 9, 7. So find the PV now. The PV this here you have 140. Here you have 10, 9, 7, 4. Please let me confirm. 7, 1, 1, 3, 4.
So it's 10, 5, 9, 7.
What?
10, 5, 9, 7. 10, 5, 9, 7.
Okay, thank you. 10, 5, 9, 7. Thank you. 10, 5, 9, 7. Okay. 10, 5, 9, 7. Yeah, you have here 6, 6. Okay.
2, 8.
2, 2, 8. You have here 3, 7, 9, 9, 6. Yeah, 8, 2, 3, 6. Yeah. 5, Abby. 9, 9, 0. Right? Okay. Now, at this rate in our class, what is the MPV to? The MPV here at this rate is what? Tell me. Yes, yes. Last, at this rate, what is your MPV? Yes, I'm waiting.
Minus 10, 9, 5, 3.
Minus 10, 9, 5.
Can you hear me, sir?
Thank you. Yes, yes, correct. Thank you. No, what, Abby? 1,000. Now recall what our IRRB Our IRR is what our lower rate, Abi, our lower rate, and then that is what 11%, Abi.
Yes, sir.
Plus the NPV, sorry, 9.5 over 9 plus this NPV here, 10.95 bracket 15 minus 11.
As in, I'm
all together. Okay, that's what 11, Abi, 11.32. Therefore, the IRR equals to 11.32%. That is our IRR. So we are still under ARB. There is still one there. Discounted payback period. You know, I couldn't show you that day. Okay. Now, class, there is a difference between discounted payback period and the normal payback period. Why? One carries an adjective, discounted. So you are what? Using the discounted cash flow. Okay? Out there, the discounted cash flow, the PV. The PV is what you are using. The discounted payback period. Let's come here and say.
Sir, there's a sir.
What?
IRR is 14.95%, sir.
Really?
IRR 14.95%.
It's 14.95.
14.95.
Thank you. Okay. Now talk so. 14.95. 14. Okay, thank you. Now, let's go to thank you. Me, I got 11.32. I don't know how you got your own.
Everybody,
me, I wanted to call your attention to it that it was 14.95.
Right.
Okay, no wala. Okay, I think 2 of you, 2 against 1. Okay. 2 against 1. Okay. Now, the discounted payback period. Class, when you say discounted, means what? You have to use the discounted cash flow out there. And the discounted cash flow here are the PV. They are what? They are the PV. These are the PVs now, be discounted. Your net cash flow is not discounted. This is what the PV. So let's go now for the discounted payback period. Discounted payback period. Out there. I told you when the inflows are not constant, okay, you are what? You are going to use a schedule. A schedule. Let's see. Yeah. Yes. Yes, you have here the item. Okay, the cash flow, the cumulative cash flow. This marker is not too bright. Yeah, it's not too bright. Cash flow. Now, year 0, remember, year 0, year 1, year 2, year 3, year 4, year 5, year 0. Okay. Now, 0 is what? The initial outlay. The initial outlay and the working capital. I mean, now, that's what? 140. Right? 140. Yes. So, here you have the PV. Okay. See the cash inflow, the PV, the cash inflow, the cash inflow, the cash inflow, the cash inflow. My PV in year 1 is 10, 9, 7, 4. Year 2, 7, 1, 1, 3, 4. Year 3, 4, 2, 2, 1, 2. Year 4, 9, 4, 8, 8. Year 5, 7, 1, 4, 8. See now, discounted cash flow. Okay, discounted payback period. Now, here we have here the total of the 140. So we have this, okay, invested, but what we have recouped 10,974. Here we are having 1, 2, okay, 9,026 left. Year 2, we also have this from there. We have here 5, 7, 8, 9, 2. Okay, 3, we have this. Okay, 1, 5, okay, 6, 8, 0. 4, we have this. 6, 1, 9, 2. See, at the end of year 4, we are having 6, 1, 9, 2 to recoup, okay? But we are having 7, 1, 4, 8 cash flow. See now, therefore, okay, the discounted payback period. Now, how many years have you actually covered? Tell me.
Yes. 4 years.
Yes,
4 years.
Yeah.
1, 2, 3, 4. 4. Okay, 4. Plus what we have here is more than what we have to recover. That way, what we have to recover over the cash flow 7148 out there. So if you do that, you have 4.866 years. Okay, that is 4.9 years. 4.9 years. That's what the discounted payback period out there. The discounted payback period. Please leave the MIRR, okay? You can do that on your own. The MIRR. Now, what is the part B of the question? Tell me. Yes. Hello, class. What is the part B?
The part B says that on the basis of MPP,
We can't hear you.
We can't hear you. Please let them position the camera to the last working now.
Okay.
Camera to the last working, please.
Now, The part B says that on the basis of the MPV. See now, they are now asking you that though you have used many methods here, okay, but on the basis of the MPV, advice should if the project should be considered. Please, class, tell me, should we? Yes. Hello, class. On the basis of the MPV, should we consider this project? Tell me.
Yes, it gives a positive MPV.
Thank you. Thank you. Thank you. The project is financially viable because it gives a positive MPV. It gives a positive MPV of 955 million. Yeah. Go on. Go on. Yes, go on, go on, go on.
Hello, sir.
Yes, go on, go on, go on.
Yes, sir.
Yes,
Hello, sir.
yes, sir. Yes, sir.
Please,
Yes,
sir,
sir.
why are we not solving the MIRR?
I will show you that.
I will show you that, okay?
In the next question. Okay. So.
Hello, sir.
And then, of course, hello, of course, you can do that on your own, okay? Based on what I have taught you in the last class. The PV of the cash inflows over the what? The PV of the cash outflow raised to what? The number of years times into bracket 1 plus R close minus 1. Is that clear? We can do that. Please go on, Candy.
Okay, sir. Sir, thank you, sir. I think we have used different method and different this is to solve it. Now we have MPV and paper period. Can they tell us we shall praise the project based on maybe we should give the best method that we can use?
Thank you. Say the best there is MPV. Are there? Why? MPV talks about absolute figure, okay? The IRR or the MIRR will talk about relative. Is that clear? So the MPV gives us the absolute figure, absolute return. But the IRR or the MIRR, they are all what about relative. Is that clear? So since we have here, okay, since we have a positive MPV, now this part C is also very crucial. I can ask you, yes, anytime you do appraisal, what are the assumptions, okay? What are your assumptions on the project, okay? What are your assumptions? Okay. The assumptions, okay, you made, it should be the assumptions you made, right? While computing this project. Yes. Next, see that here. Let's come here. Because what I will show you here, you can also apply to another question. Yes. The assumptions is just about thinking. Of course, you know that all the cash flows, okay, we use here, they are based on assumptions. So assumptions, okay? used in calculation. So what are they? Number one, okay, we have the cash flows. Number two, there, the depreciation. Number three, here we have the sunk cost. The sunk cost. Number four, there, here we have the cost of capital. The five, here we have incremental fixed cost. So I will give you short note here, please. Be with me now. With me. You know, appraiser is a future thing. Out there is a future thing. So you can't say that, oh, I am going to receive 10 million for the next 5 years. Who said so? It is just an estimate, okay? It's an estimate, yes. Now, one, please write. One. It is assumed, please write, it is assumed that the cash flows estimates are reliable and will occur at the end of each year. Yes, it is assumed that the cash flows estimates are reliable and it will occur at the end of each year. Is that clear? Number two then is depreciation. Now, this is not a cash item. Yes, this is not a cash item, therefore considered irrelevant. Depreciation is not a cash item, therefore considered irrelevant. Next, there's some cost now. The development cost and market research costs are sunk costs, and therefore considered. Okay, sorry. The third one, okay, the sunk cost. The development cost, okay, and market research costs are both sunk costs, and are therefore considered irrelevant. Yeah. The next now, cost of capital. It is assumed that the cost of capital, calculated is appropriate and consistent with cash flows. Yes. The last one, incremental fixed cost. Okay. It is assumed that incremental fixed cost will not change. Yes, will not change within the relevant range of activities. It is assumed that the incremental fixed cost will not change within the relevant range of activities. You see, under any question that involves appraisal, you'll be asked, okay, to state the assumptions you use. Just look for some of the cash flows, okay? If you have some cost there, use it. Okay, I'm coming. Okay, if you have this in there, the incremental fixed cost, use it. You can just pick any of these cash flows, and explain them. All we have here, to be candid, they are just based on estimates, right? They are just mere estimates based on projection. Okay, go on.
Sir, I didn't
Azima.
get that capital. You said, sorry, sunk cost. You said the development and market costs are both sunk costs. Therefore,
yes, considered irrelevant.
Okay, sir.
Okay. So, class, please, you will do ourselves one favor by watching this video. This is a normal appraiser without diversification. On Monday, we are going to look at an aspect that involves when the main company diversify, and you are asked to calculate the specific project cost of capital first before the appraiser. You can see. So please, thank you very much. Till we meet on Monday by God's grace. So, class, any question on that? People are tired because they are not used to staying this long.
Sister, thank you for the class. Just help us drop the
Yeah.
video. Thank you.
Okay.
Yes, sir.
Once it's uploaded, sure, I will drop it. Okay.
Thank you.
Yeah.
Thank you, sir.
Thank you for the
Okay,
class,
yeah.
sir.
Yeah. Welcome, sir.
So when we do the MRR, yes.
I even understood that MIR.